Hello, good morning. I'm Robin Henry. I'm the Head of Dispute Resolution at Collyer Bristow, and welcome to Collyer Bristow's Financial Services Winter Update. Today I'm with my colleagues, Jean-Martin Lowe and Janine Alexander. Jean will be discussing the challenges that financial institutions face when trying to balance compliance responsibilities with customer care obligations and what businesses can do if a bank has frozen their account or threatens to discontinue their banking services. Janine will be examining the law on guarantees and the circumstances in which they can be challenged when the relationship between a lender and borrower has broken down. And I will be discussing how borrowers can anticipate breaches of loan covenants and what lenders and borrowers can do to navigate their way through potential loan defaults. We'll have some questions at the end, and if you do want to ask a question, please type your question into the Q&A box at the bottom of your screen. And just to mention that after the webinar, we will be circulating a recording of it and together with the slides. And with that, I will pass you over to Jean. Thank you, Jean.
So as Robin says, what I'm going to be speaking about is situations where a bank or e-money institution decides to freeze or close your account and what you might be able to do about it. It's a situation that we are seeing quite frequently, and more often than not, it seems to be challenger banks, the newer entrants who are involved. And the problem seems to be that those institutions are struggling to balance their compliance responsibilities and their appetite for de-risking with their customer care obligations. The unfortunate result obviously being that ordinary customers are getting caught in the crossfire because they are being left without access to their funds for considerable lengths of time, which has the potential for very serious consequences. And what we're seeing is that banks are, in many cases, just holding on to people's money indefinitely, whether out of fear of breaching their regulatory obligations or just out of inefficiency because they don't have the resources to deal with the compliance issues. But the situation is very unsatisfactory from a customer's point of view. So let's start by talking about the reasons why a bank might want to discontinue its relationship with a customer. Really, the reasons can be myriad. It's usually related to some perceived risk on the account, whether that be credit risk, reputational risk, or some other perceived risk stemming from the bank's lack of expertise in relation to a particular industry or business or country. So, for example, a bank might take a policy decision to stop banking with ship owners if there's a spate of defaults due to piracy, or they might decide to stop banking anything to do with the gambling industry due to reputational or money laundering risk. And a bank's terms and conditions will generally have a very vanilla looking provision like this one on screen, which says they can end their agreement with you and close your accounts for really any reason, provided they give the required amount of notice. And there will also be scope for the bank to close your account immediately if they suspect a customer to be acting fraudulently. The next slide, please. So, on the other hand, if we're talking about frozen accounts where no notice has been given and the customer finds that their account has simply been blocked, the most common trigger will be concerns around money laundering or fraud. And that might be because large or unexpected sums have been transferred in or out, particularly where the account in question has links to certain countries that are deemed higher risk. And in that situation, the bank's powers generally look something like the examples that I've put on screen. You'll see they can suspend or block an account in exceptional circumstances where they are reasonably concerned about fraud or about the safety of an account. But most importantly, they can do so if it's necessary in order to meet their legal obligations. So behind a bank's contract with a customer sits its regulatory and legislative obligations, the most important of which for present purposes come under the Proceeds of Crime Act, commonly referred to as POCA. And because of the obligations placed on banks under POCA, when an institution suspects that money laundering is going on, it must freeze the account and then report the matter to the National Crime Agency, the NCA, by filing a suspicious activity report, which in essence is a request for permission from the NCA to proceed with the relevant transaction. And I'll just mention that in this context, the word suspicion has been held to mean a mere possibility which is more than fanciful. So it's a very low bar, which you can see being triggered quite easily. And the banks are extremely cautious in these situations because failing to report their suspicions to the NCA can result in prosecution and enormous financial penalties. Next slide, please. So what happens after the bank asks the NCA for permission to proceed with a transaction? That triggers a moratorium period during which the account will remain frozen. Initially, the NCA has 7 working days within which to respond to the bank by either agreeing that the suspension should be lifted or by refusing consent. If the NCA refuses to give consent, it will then have a further 31 calendar days to carry on its investigations. And again, during that period of investigation, the account must remain frozen. And importantly, the bank is prohibited from disclosing anything about why the account has been frozen, because it's a criminal offence to tip somebody off about the existence of a suspicious activity report as well. So the upshot of all that is that, for at least 38 days, whilst that process plays out, there may be very little that a customer can do, save for perhaps trying to explain any circumstances which they think might have triggered a suspicion in the first place, and seeking to give the bank some comfort that nothing untoward is going on. But during that 38-day period, the bank can pretty much ignore a customer or refuse to execute their instructions and tell them nothing about what is going on. So it can be a very frustrating thing to deal with. At the end, or at the conclusion of that moratorium period, the NCA must either permit the transaction to go ahead or seize the funds in question. They can apply to the court for more time, but if they do so, then the account holder will be given notice of the application. So that means that if after 38 days, an account holder has not received notice of an application to extend that moratorium, they can assume that the NCA has okayed their funds to be unfrozen, and we call that implied consent. However, in our experience, that doesn't mean that the funds will actually be released by the bank, because sometimes, even where it looks as though all the relevant timeframes under POCA have expired, the customer's money will remain frozen, sometimes for months and months on end. And now that might be because the bank's internal processes are lagging, particularly at challenger banks where it appears as though their internal compliance and legal teams perhaps don't have the resources to keep up with the volume of work. Or it may be that there's some other reason why the bank remains concerned about breaching its regulatory obligations. Obviously, from their perspective, because of the potential repercussions, it's safer for them to do nothing than to release the funds. And when a customer has no visibility of what is happening at the bank's end, it can be incredibly difficult to find fault in their behaviour and challenge what they're doing. But nonetheless, in recent matters, we have found that keeping pressure on the bank generally yields faster results in terms of getting accounts unfrozen. So on that note, what can customers actually do to keep the pressure on? If we just move to the next slide. Well, just taking a step back from frozen accounts for a minute to look at situations where the bank simply wants to discontinue its relationship with a customer, whether because of de-risking processes or for any of the other reasons that I mentioned earlier. Generally speaking, provided adequate notice has been given, there may be little that a customer can do to challenge a bank's decision. The Financial Ombudsman requires a bank to give reasonable notice of at least 30 days if they intend to close a personal bank account, and that's intended to allow the customer sufficient time to make alternative banking arrangements. And obviously, it's recognised that a longer notice period may be appropriate for business customers as well. That said, the reasonableness of a bank's conduct can always be measured against its customer care obligations in the FCA Banking Conduct of Business Sourcebook, often referred to as BCOBs. And that requires a banking institution to always pay due regard to the interests of its customers, treat them fairly, communicate information to them in a clear manner. And particular care has to be given when dealing with a customer who might be in financial difficulty. And with that in mind, at present, we would think that the fairness of any bank's decision to close an account must surely be viewed in light of the ongoing pandemic. And customers can ask the Financial Ombudsman to review a bank's decision and look at whether it was fair. Given the difficult circumstances for many businesses find themselves in at the moment, the closure of an operational bank account on very short notice could have a severe impact on an organization's ability to continue trading. There may be other reasons why, outside of the business's control, why it's difficult at the moment to open a suitable alternative bank account. Banks are probably very busy at the moment dealing with the many issues which have arisen for their existing customers, which means their main focus at present might not be on opening new accounts. So complaints to the Financial Ombudsman are a possibility. And earlier in this year, the FCA actually wrote to banks asking them to be focused on ensuring that SMEs are treated fairly in the current situation. So even if a bank appears to be acting within their contractual powers to close an account, the Ombudsman may be more sympathetic than usual towards businesses. And so it may be worthwhile making a complaint about the bank's actions, which could then result in an award of monetary compensation. And it's also just worth mentioning that if a bank's decision to close an account is going to have particularly adverse consequences, then it may be possible to apply for a court injunction restraining the bank from doing so, but that is very difficult. If we can just go to the next slide, please. So turning to frozen bank accounts. If you find yourself in a situation where an account has been frozen without notice, you can pretty much assume that it's due to concerns around fraud or money laundering. Generally, as a first step, you should try to provide the bank with as much information as possible to comfort them that your account is not being used for any such purposes. And you should keep as much pressure on the bank as possible to release your funds. I mentioned earlier the relevant timeframes under POCA. So if after 38 days, the bank still maintains a block on an account, there may be further steps which can be taken and threats of legal action which can be made. So firstly, if you're suffering financial losses as a result of the bank's conduct, for example, you're losing business or you hold a trading account and share values have dropped, then there may be scope to commence court proceedings to recover those losses. And you can also make a complaint about those losses to the Financial Ombudsman, who can order the bank to compensate you. So those are legitimate threats of legal action which can be made to put pressure on the bank. And also, if the amounts of money involved are large enough to justify it, then you can consider applying to the court for an order for specific performance, which compels the bank to carry out your instructions and release your funds. In both of those situations, you would need to prove that by freezing your account or refusing to make payments, the bank is actually in breach of its terms and conditions, which again is difficult when they aren't required to tell you why they're holding onto your money. But if the timeframes under POCA have run out and it appears as though the bank has implied consent to release your funds, then it can be argued that any lingering suspicion which they might have is unreasonable, and that by refusing to release your funds, they're in breach of contract. And that's about it from me at this stage. I hope it gives you a flavour of some of the issues that are generally in play around frozen accounts. As I say, we do deal with this issue quite a bit, so do feel free to get in touch if anybody needs any specific advice. But for now, I'll pass on to Janine.
Good morning, everyone. Well, as 2021 is anticipated to be a very turbulent year for lenders and businesses as the COVID crisis plays out, we thought now would be a good time for a refresher of the law and issues that can arise around guarantees in the context of commercial lending. So just Darren, next slide, please. So just to have a quick look at the common situations that can arise. Typically, banks will ask for personal guarantees, usually from a shareholder or an investor in the business. Sometimes a guarantee from a spouse or partner. I'm not going to dwell too much on that aspect of it because there's a lot of considerations there regarding potential undue influence, and lenders are usually very careful, and any dispute about that's going to be very specific to the circumstances. But it's a common mechanism used for security. The other type of guarantee is parent or connected company guarantees, cross-company guarantees. These can involve quite complex structures, and there are capacity and corporate governance considerations which lenders will also want to be very careful about as well. Next slide, please. So a guarantee, is it a guarantee or an indemnity? It may be referred to as a guarantee by lender and borrower at the time, but very often, particularly if you're borrowing from a bank, what you're actually entering into is both a guarantee and an indemnity. The difference is a guarantee is a secondary obligation, so the guarantor has no obligation to the lender unless the borrower has an obligation to the lender. It depends on the underlying relationship between the lender and the borrower. An indemnity, however, is a primary obligation directly between the guarantor and the lender. It's a contractual promise by what we would refer to as the guarantor to accept liability for the lender's loss in relation to the underlying transaction relating to the borrower. And that liability is there whether or not the borrower is actually also liable. So that's obviously much better for the bank, and guarantors have quite a lot of lines of defence potentially if there's a dispute about guarantee than someone who's given an indemnity. An indemnity does require there to be very specific and clear wording. Courts are very reluctant to accept that someone has given an indemnity as opposed to a guarantee unless it's very clear in the wording that that's what's happened. Standard bank guarantees, as I said, are usually contain both obligations, both types of obligation. Can I have the next slide, please, Darren? So what are the practical considerations if you're a guarantor or a potential guarantor and the borrower's loan is in default or is potentially going to be in default? So commonly, various things will happen. The lender may start by initiating a security review for its purposes to check whether it's happy all the security it has is in place, is adequate, and is properly set up. The lender may also appoint reporting accountants to go into the business and investigate its financial position and ability to continue repaying the loan, and then report back to the lender. There may be requests for security perfection if the lender finds something that's not in order, or for additional security, including additional guarantees from other companies connected to the business or from the owners. Caution at this stage is recommended for guarantors and potential guarantors. This is an area which I would call the danger zone in relation to the potential for disputes in relation to guarantees. What often happens is that the reason the guarantor is giving the guarantee is in order to keep the business afloat, essentially, by preventing the lender from enforcing. And that's done on the basis that the lender will say, or that, in the expectation from the lender, that they will continue to support the business if the guarantee is given. However, that's not necessarily going to be the case. And if you're relying on assurances of ongoing support from lenders, it's very important to check if they're in writing and to make sure that it's clear. Are they contractually binding? It's often easy to get the impression that a lender is intending to be contractually bound when they may not be. And again, a dispute can arise about whether or not they did actually promise on a contractually binding basis. And also, it's very important to check the scope of any guarantee that's being requested. If a guarantee is being requested because one particular part of the business is in difficulty, is the guarantee limited to that part of the business, or is the lender looking for wider security over to cover different parts of the business which are perhaps not under specific consideration? So it's important to know exactly what you're getting into, and also to keep notes of everything that's said. Partly the reason for that is the lender will almost certainly keep very good notes, and there will be notes which will be informed by the lender's experience of the sort of things that can cause disputes. So they will focus on recording the things that will be beneficial to the lender to have a record of. And that's not a criticism, but quite often what happens is that guarantors or the borrower's representatives haven't kept the same level of notes. And then that causes problems if there are factual disputes about what was said or what's happened and what was promised. Legal advice at this stage is very important before a dispute arises, so that everybody understands what their obligations are and what's being done and what's happening and what the lender is and isn't entitled to do. I acknowledge that it may be practically difficult in circumstances where a business is cash strapped, and that may also be having an onward impact on guarantors depending on their connection to the business, whether it's another company or whether it's an owner. But legal advice at this stage is really, really useful in minimizing the potential for disputes, and also in ensuring that the guarantor's position is protected as so far as possible if there is a dispute later. Could I have the next slide, please? So what will happen then if it goes further than discussions and negotiations in support of the business? There will first of all be a demand letter, which will have a particular form and content. It will have to be addressed very carefully to the particular guarantor, and there will likely be contractual and notice requirements to be complied with. So it will be a formal letter will be sent demanding payment under the guarantee. If payment is not made and the demand is not satisfied, the next step for the lender will be a letter of claim, which will set out its position and threaten legal proceedings, essentially, if the demand is not met. Legal proceedings then may follow, again, if the demand is not met. They may be defended or not defended, and then there'll be judgment and enforcement. And the procedure overall is likely to take a number of years, depending on whether the proceedings are defended. In case of a dispute, our advice is to take early action. Early legal advice is really important to understand your position, and it's also really important to set out your position early. Credibility is very important, usually in this sort of dispute, because they almost inevitably arise from disputes about facts of what happened, what was said, why the guarantee was entered into. And it's not a very good position to be in front of the court if it eventually gets that far. If you are raising factual allegations at a late stage in proceedings, or only after proceedings are issued that you don't mention beforehand. Equally, it's important to, before you start entering into discussions with the lender in relation to a dispute, that you understand the lender's rights, as in you've taken legal advice to understand exactly what each party's position is. Misconceptions in this area are very common. A particularly common one is that the lender has to exhaust other security before it calls on the guarantor. That's not correct, almost certainly not correct, based on most standard wordings. And so often parties can ignore demands under guarantees, thinking that they're irrelevant or not important, because they think that the lender will get paid through enforcement of other security. That's a difficult position to be in, because then it appears as if if you have got a genuine dispute about whether you're liable under the guarantee, you haven't raised your points and made your position clear early. So early legal advice, I mean, everybody actually would say that, but we've seen it's very frustrating for lawyers when we see someone come to us with a genuine dispute who's been treated unfairly, but who hasn't taken legal advice early and has damaged their position either by ignoring correspondence or by making arguments based on internet research that doesn't reflect the particular wording of their guarantee, that then make their genuine arguments look less credible. Could I have the next slide, please? So the first thing to check is the demand properly made? Notice requirements complied with is one thing. That's not something I'm going to dwell on, because actually it's rarely in a guarantor's interest to take issue with the form of the demand, because the bank is usually able to just send another one, and it doesn't make you look as if you're engaging fairly sometimes if you're taking technical points. However, what is certainly worth looking at is, in relation to whether the demand's properly been made, is whether there's a dispute about the existence of a default. What does the lender require to prove in order to make it possible for it to make a demand under the guarantee, and has that been satisfied? So I'm not going to dwell on these disputes about default, because Robin's going to talk more about that. But examples are material adverse change clauses, where the lender's relying on there having been an adverse change to the business's situation, which the business may not agree with. Loan to value covenants, the business may not agree with the valuation of the assets that's being alleged in order to show a breach of a covenant there, or other covenant breaches. So that's something to check in relation to whether the demand has properly been made. Another issue to consider is, why was the guarantee entered into? Is the guarantor surprised to be called upon in this situation because it was represented to it that something would happen or wouldn't happen, or was the case that wasn't? Why was the guarantee entered into? Why is the guarantor aggrieved that the demand has been made? Why does the guarantor say that they shouldn't have to pay in this situation? Misrepresentation is a particularly common issue regarding the sort of late guarantees that I was referring to earlier, as in those that are given in order to support a business that's already in difficulty and already in negotiations with its lender in a situation of default or potential default. So I talked a little bit earlier about the importance of keeping notes. Guarantors, I think, do need to be careful, not that they understand exactly what the bank's position is, and that it should be investigated in a situation where a guarantor has given a guarantee on the basis of assurances of ongoing support. It's important to investigate why those representations were made if the bank is now enforcing, when it decided to enforce, and to make sure that the guarantor hasn't been misled into entering into the guarantee on the basis that the bank would continue support that was never going to be forthcoming. I mean, it's obviously going to depend on the particular factual situation, but that's a common issue that we see, and it does require investigation. In relation to misrepresentation, this can include misrepresentation by non-disclosure, but that's a very limited category of non-disclosure. It must be very unusual facts, and it must relate to the contractual relationship as opposed to just anything to do with the borrower or the particular transaction. But that's something worth considering as well. Next slide, please. Some guarantors will argue that they've entered into the guarantee under undue influence and therefore it's vitiated. What I would say is in a situation where it's a business that's commercial and sophisticated and run by experienced business people, the court is likely to look very sceptically on any claims by undue influence. It's obviously can't be ruled out entirely without looking at any particular factual circumstances, but undue influence is a difficult argument for most sophisticated businesses to run, and even most businesses in general. In fact, it's much more difficult than in other situations where people have been influenced into giving guarantees. In relation to capacity, did the company or the particular entity have capacity to enter into the guarantee? So in relation to corporate entities, that's obviously a question of looking at their constitution or articles of association. Banks are generally quite careful to have dealt with that at the outset, but it does sometimes arise. Personal capacity, I'm not going to dwell upon really. I mean, it's an obvious point and will depend on the particular circumstances and situation, whether or not an individual had personal capacity to enter into a guarantee. And then back to the question of whether it's a guarantee or an indemnity, it's important to check this because a guarantor has more potential rights and potential defences as opposed to whether if it's an indemnity. There's a requirement for a guarantee to be in writing or evidence in writing. In this context, that's usually a non-issue because there will be a form of guarantee. The guarantee, but not the indemnity, can be set aside in circumstances where the underlying transaction is set aside. So that's an issue to consider carefully in a situation where there's a dispute between the borrower and the bank, is whether or not you've got a guarantee or an indemnity, and because it can make the difference between having to pay and not having to pay if the borrower succeeds in the dispute. And the other issue that affects guarantees but not indemnities is whether there's been a variation without consent. So if you have a guarantee, if the guarantor's complaint is that the underlying loan transaction was varied materially without their consent, and therefore that they should no longer be required to pay under the guarantee, that's an issue for guarantees. It doesn't apply to indemnities. It will still, the guarantor will still be allowed to be required to pay if the guarantee is in the form of an indemnity.
Thanks, Janine. Yes, I'm going to be dealing with the issue of loan defaults and the risk of those and how to deal with them. Next slide, please. Now, I don't need to tell you what's the current situation is in terms of business banking customers. Thousands of businesses are at risk at the current time of loan default as a result of the COVID-19 crisis. We've just had Arcadia and Debenhams go into administration, which I'm afraid are going to mean that a large number of their suppliers are also going to be in severe financial difficulties. In the strange situation that we are in, which is and hopefully a very temporary situation, both lenders and borrowers want to avoid unnecessary loan defaults. And so what I'm wanting to look at is just some of the techniques that borrowers and lenders can use in order to avoid unnecessary defaults. And I would expect that there will be intensive negotiations going on between lenders and borrowers in order to keep businesses operating until we are past this crisis and unfortunately beyond. Next slide, please. Now, one of the key points to mention is that in order to avoid unnecessary defaults, a borrower needs to keep a firm grip on its understanding of its financial position at all times and to carefully monitor its financial covenants. And it needs to make sure that there is that they're clear as to how their financial position can affect the risk of them being in breach of their financial covenants. Now, financial covenants fall into two broad categories. You've got positive ones, and I've mentioned some examples there on the slide, such as cash flow cover, interest cover, and debt service cover. So debt service cover ratio is broadly a question of whether the business has sufficient earnings in order to pay its debt interest and principal. So you would divide the business's EBITDA by principal and interest payments and come up with a ratio, and the ratio would have to meet that set by the bank. Cash flow ratio is where answers the question of whether there is sufficient cash being generated by the business in order to meet its debt obligations. And debt service cover is where it both interest and principal payments are examined. There are also negative covenants, such as where the business agrees not to incur additional debt elsewhere, not to impose new debt obligations on the business. So the first thing the borrower needs to do is it needs to know when those financial covenants will be tested and whether it's likely that they could be breached when they are tested. So what the business should be doing is building into its financial projections, bearing in mind the test dates which are coming up when the financial covenants need to be tested. They need to keep an eye on when they need to provide that financial information to the bank, and they need to be alert as to when applying different sensitivities to their financial projections, this would suggest that there is a potential for covenants to be breached. If a covenant is at risk of being breached, then customers need to speak to their lender as soon as possible. I can't emphasize that enough. Waiting until the last minute to disclose a breach is almost universally a bad idea. Bankers do not like surprises, and they react badly when they are presented with them. Businesses, is much better for them to explain the reasons for the potential breach, be realistic about the possibility, and work with the lender in order to avoid the breach from occurring. If a breach does then occur, the parties will have had time to prepare and consider their next options. Now, this is quite a commercial aspect of a business's operations, and you might think, well, where's the legal input necessary? But I think this was touched on by Janine. You need, first of all, to understand, or a business needs to understand, the legal consequences of a breach of contract, a covenant. A covenant breach, no matter how minor, is a technical violation of the loan agreement. Now, you're going to need to look at the details of the loan agreement to see what the consequences of each particular breach of covenant are going to be, because they may be different, but it is likely that a breach of covenant will result in an event of default. And again, you need to check the loan documentation to see what the events of default are and what the consequences of those events of default are. But it is likely, again, ultimately lead to the bank having the right to accelerate the loan and demand immediate repayment of the whole loan. So a breach of a technical financial covenant can have very serious consequences for a business. Now, the bank may not, particularly in these current times, the bank may not wish to go as far as accelerating the loan and demanding repayment. It may much prefer simply to preserve its current legal position by issuing a reservation of rights letter, or it may seek to impose particular penalties. Additional risk may mean that the bank wants to impose additional interest payments, or take additional security, or, as Janine mentioned, conduct a security review, or impose a one-off monetary penalty. So there are a number of different penalties which could be applied by the bank. Next slide, please. Now, there are a number of different possible steps which a business can take in order to avoid a breach, or if there is a breach, avoid penalties. Is it possible to adjust the company's financial figures? It is possible to do that, but I have to say that it is highly advisable that if a company is going to start manipulating its financial figures, it needs to have the lender's agreement. And there have been examples this year of businesses agreeing with their lenders that they will adjust their projected earnings figures. So there's a term which is now current called EBITDA, which is earnings before interest, tax, depreciation, amortization, and COVID, with the extra C, because what companies are trying to do is to reflect the profits they would have made if it hadn't been for the effects of the virus. Some of them are also putting forward last year's profits as being applicable to this year for the same reason. They can do that if they get the lender's consent and agreement. And there have also been cases where businesses have used that kind of adjustment in order to seek additional finance externally, which is extremely common at the moment with companies trying to raise new finance. So that is possible, but it would be an extremely bad idea, I think, to do so without the lender's consent, or to try to hide the current position. It is much better to be honest and open about what the current financial position is. Otherwise, it will have the effect of destroying the trust and credibility between the parties. So issues to be considered in terms of avoiding the consequences of a potential breach. What is the breach? Is it fixable? Can it be cured? And within what time could it be cured? Is there a grace period to allow the breach to be cured? If there isn't a grace period, can it be negotiated with the bank, or can it be extended? So it needs to be, you need to explain to the lender the effect of the penalties on the business. If you suspect and you can see from the loan documentation that the bank could impose penalties, you need to factor that into the financial projections you're providing to the bank and say, if you impose such and such penalties on the business, this is going to be the financial position. Next slide, please. Now, there are a number of different ways, or any number of different ways in which you can agree with the bank to adjust things in order to avoid a potential breach of financial covenant. You can agree to suspend the test date. So if you've got a test date for a covenant coming up in the next few months, you could say, okay, well, we won't have that test date this year, and therefore there will be no breach. You can ask for the covenants to be amended temporarily, so to change the ratios for debt service cover or interest cover or any of the other covenants which apply. If there is a technical breach, you can ask for the bank to waive that breach, and it will provide a formal letter of waiver. Alternatively, if it's not willing to do that, it might be willing to reduce any possible penalties. And looking ahead, one of the reasons in order for negotiating with the bank is, on a strategic level, it's to buy time to consider the other options which are available. And in all of these things, I think, as Janine has mentioned, it's very important that businesses obtain legal advice. And there's a couple of reasons for this. It's very important that businesses are clear as to what it is that the bank is agreeing to do. The banks are professionals at this. They are used to negotiating their way around financial covenants. Many of the businesses who are facing this potential issue at the moment are sound, profitable businesses normally, and have never had to consider dealing with potential breaches of financial covenants. And therefore, it's very important that borrowers particularly take legal advice on the short-term negotiation and understanding what each side has agreed, but also for the more long-term options in terms of refinancing or restructuring. Many companies at the moment are considering whether or not they can restructure their debts in order to avoid breaches. So looking at informal restructuring options, or more formal ones such as a CVA, the new moratorium issued, which has been introduced by the Corporate Insolvency Act 2020, or a scheme of arrangement, or the new restructuring plan, again issued by the new Insolvency Act. Next slide, please. Now, one difference about the current situation, I think, is that the regulators have taken much more proactive interest in this issue, and they are trying to learn the lessons from the 2008 financial crisis. The PRA and following the financial crisis, banks faced a lot of criticism for failing customers, particularly SMEs. That resulted in FCA schemes to compensate customers, for example, over interest rate hedging products, or the treatment by RBS's Global Restructuring Group. And both the FCA and the PRA are keen to ensure that banks take a more socially responsible way of behaving, with a view to avoiding nationwide loan defaults. Next slide, please. So the regulators have advised financial firms that they need to consider carefully their responses to potential breaches of covenants arising from COVID-19. And what they've said is that where problems are unrelated to the solvency of the borrower, then lenders are expected to consider waiving covenant breaches and not to impose new charges or restrictions unrelated to the reasons for the breach. And what's interesting is that the FCA recognises and says that commercial lending is broadly unregulated, and so the FCA has said that what it intends to do is to try and use the senior managers regime in order to ensure that senior managers who are responsible for SME lending are correctly discharging their responsibilities. Next slide, please. The FCA has also created a small business unit to coordinate the activities of the FCA across small business issues. And if the customers have any concerns about poor conduct and/or outcomes, they can raise this with the small business unit. However, because commercial lending is not usually regulated, there are questions which remain as to whether or not SMEs, as a result of the actions of the FCA in this respect, actually have any more legal remedies than before. And I think we'll have to wait and see how effective they have been. But as I have said earlier, the best hope for all concerned is to avoid defaults in the first place. And we've had a lot of experience of negotiating primarily on behalf of borrowers in terms of trying to navigate their way through the potential risk of loan defaults. And that's all from me. And so we do have some time for questions. So the first question, John, I think there was a question that was asked for you.
Yeah, I think somebody asked why I mentioned that it's often difficult to obtain an injunction or an order for a specific performance in practice. And the question was, why is that the case? And the answer is that the ordinary remedy when someone breaches a contract is an award of monetary damages to compensate the other party for their loss. Now, an injunction or an order for specific performance will only ever be awarded if it can be shown that monetary damages would not be an adequate remedy in the case, which is very difficult to establish. You know, you have to show that money is not enough to compensate the innocent party. So, for instance, you might be able to point to some kind of irreparable harm to the customer's business as a result of the bank's actions, but you know that is tricky. The most promising potential avenue that we have found is to get over this hurdle is that sometimes a bank's terms and conditions will try to exclude any liability to customers in respect of lost income or profits. And if the banks try to rely on those exclusions, then that can in and of itself be a sufficient reason to why you might say that damages are an inadequate remedy because you can't get them due to that exclusion. But in a nutshell, that's why it's difficult.
Thanks for that. Janine, there's a question here. If LIBOR transition results in a higher rate of interest being payable, is the guarantor potentially liable for the increased interest rate without the guarantor being consulted or agreeing to the variation?
Yes, interesting question and very topical. I mean, a variation without consent is something that can vitiate a guarantee, but the guarantor would have to show, first of all, that they haven't consented, and sometimes consent will be in advance in the form of guarantee documents itself, at least to some extent. And the guarantor would also have to show that it was material and adverse to their position. And with LIBOR transition, it's not quite clear whether or not that will affect borrowers and guarantors or not in any significant way, because it depends what LIBOR is and how it all works and how the transition has been affected. So the answer is, I think the answer is probably not, unless there are very severe consequences of it in the first instance. I mean, if you're the lender, it's probably advisable to get the guarantor's consent to any change. But yeah, from the guarantor's perspective, it seems unlikely.
Thank you. I've been asked a question: what are the rights and remedies in the event of the borrower's insolvency? Quite a wide question. The answer is that normally the bank would take a fixed and floating charge under a debenture. That would give it the right to appoint an administrator in the event of default. It could appoint one pretty much immediately on demand, failing payment by the borrower. But that is very much the nuclear option. And in the current circumstances, I think that is what people are trying to desperately to avoid. We've seen, these high street chains go into insolvency, but they were always under pressure. They've been under pressure for several years now. Places like Debenhams and Arcadia, they are the ones which are the most vulnerable and have suffered as a result. And there haven't been really any other options available to them. In terms of the majority of businesses, I hope that they will be able to continue to avoid the full consequences of an event of default, but it is always available. To lenders in those situations. So it's a very precarious situation for a lot of businesses at the moment. Then I've got another question. Do you predict mass disputes litigation between borrowers and banks re-COVID support loans? And/or will the government step in further and inject more support, continue to change the laws? Well, I'm happy to start off with that one. I think that when the lockdown started, we were thinking that a huge number of businesses were going to go into insolvency quite quickly. The government, I think, has done a lot at a massive cost in order to support businesses. They have continued that support largely, and they have continued some of the changes to the law, which have prevented, for example, winding up petitions being issued as a result of COVID-related reasons. They've continued those until March. So I think it will be, if there are insolvencies and litigation, I think it's going to be more of a case of rather than an explosion from a balloon popping, but rather just air escaping from the balloon slowly over time. But I think, there will be a large number of insolvencies and a lot of litigation, but I think it will take time for us to see that develop. I don't know if Janine and Jean had any other thoughts on that, or if they had anything else to mention.
Yes, I agree with that, and I think it will take time, but there will inevitably be insolvencies because, to some extent, it depends on how much the world gets back to normal, because the government is at the minute indicating it's going to support people through a temporary change in their business, and that probably, in my view, will continue, although for how long and to what extent is less clear. I think where there may be more potential for dispute is between in relation to guarantees, actually, and in relation to the owners of businesses, because there's been a lot of tension in the way the government has managed this between whether the banks were going to shoulder, the government was going to shoulder, or the owners of the businesses were going to shoulder. So we saw, for example, the restrictions on guarantees that were allowed around the COVID loans, but that won't apply, obviously, to guarantees that were given before all of this happened. And so I think banks, if they're facing losing money, even if they're willing to carry on and try and support everyone through it, they will be putting pressure on the owners of businesses to put their assets into the mix as well, in order to support employees and the economy in general.
Thank you very much. I don't have any other questions, so I think we'll end there. Thank you for attending, and if you do have any other questions you'd like to ask any of us, please feel free to contact us, and we'd be happy to answer any further questions. Thank you very much for listening.